Last week, Japan injected $35 billion into its markets in a single day. This wasn't for military operations, nor a bailout of banks. The government was scrambling to prevent its currency from collapsing. The yen had just touched 160.7 against the dollar, marking its weakest level since July of 2024. Alarmed, Japanese authorities discreetly funneled $35 billion, equivalent to 5.48 trillion yen, into currency exchanges, attempting to staunch the decline. The intervention barely stabilized the situation. The dollar's rise was not a signal of American economic strength. Instead, it was driven by soaring oil prices following the conflict in Iran. Nations heavily reliant on imported energy were quietly feeling the strain. Japan, which imports over 90% of its crude from the Middle East, is especially vulnerable. When the Strait of Hormuz experiences disruptions, Japan suffers, and those effects ripple into the currency markets globally. What unfolded in Tokyo is thus not merely a story about Japan, it is a reflection of the broader trajectory of the US dollar. The situation is far more complex and precarious than mainstream financial news suggests. A chain of events began in a war zone, traversed through Tokyo, influenced the dollar, and ultimately affects precious metals. Yet, despite these pressures, gold and silver remain priced far below where they arguably should be. Understanding the mechanics behind this cascade is essential. The sequence starts with recent developments at the Federal Reserve. On April 29th, Jerome Powell conducted his final press briefing as chair. The Fed maintained interest rates at their current levels as widely expected. However, the internal dynamics of that meeting were extraordinary. 4 officials dissented, the highest number since October of 1992. The point of contention centered around a single word in the statement: additional. The Fed suggested it might consider further adjustments, but 3 regional presidents, from Dallas, Cleveland, and Minneapolis, interpreted this wording as signaling a bias toward easing. They argued such language was inappropriate, given surging inflation and skyrocketing oil prices. A 4th dissenting official advocated for immediate rate cuts. This divide is telling. The Federal Reserve is not merely stagnant, it is fractured. Half of the committee views the economy as slowing and calls for cuts, while the other half warns that reducing rates amid oil prices over $100 per barrel would exacerbate inflation. Both perspectives are valid. This split exemplifies the stagflation trap. Soon, Kevin Walsh, selected as Powell's replacement by the former president, will assume leadership. Markets anticipate that Walsh might adopt a dovish stance. Yet, 3 Fed presidents have publicly declared they will oppose easy cuts. The institution is splintering precisely when decisive guidance is most crucial. For retail investors, this has tangible implications. With the Fed caught between inflation pressures and economic slowdown, the dollar lacks solid backing from interest rate policy. Its value drifts. At first glance, a weakening dollar would suggest higher prices for gold and silver. A simple inverse relationship. Yet, reality is more nuanced. Earlier this year, gold reached a record of $5,595 per ounce on January 29th. It currently trades near $4,600, a decline approaching 15% from its peak. Silver, which once climbed above $90, now sits around $76 per ounce, also well below its recent highs. The superficial narrative of a falling dollar driving metals higher misses the deeper currents shaping the market. Despite a weakening dollar, precious metals have been sliding, even as the Fed remains immobilized and a major conflict disrupts 20% of global oil supply. On the surface, it seems illogical. Yet, the explanation lies in energy-driven inflation. When Brent crude soared to $126 per barrel in late April, its highest point since March of 2022, the impact extended far beyond gasoline prices. It shifted inflation expectations for central banks worldwide. Higher expectations compel these institutions to maintain elevated interest rates for longer periods. Elevated rates carry a cost for holding gold and silver. Investors sacrifice bond yields to retain metals that produce no income, prompting institutional funds to exit precious metals. This rotation has caused prices to decline, but the crucial detail hidden from retail investors is that this exodus is temporary. The underlying structural dynamics supporting gold and silver remain intact, and in fact, they are intensifying. Examining central bank behavior reveals a stark contrast between words and actions. In the first quarter of 2026, the World Gold Council confirmed that central banks had continued to expand their gold reserves. Over the past 3 consecutive years, a total of 2,745 tons have been acquired, with over 1,000 tons purchased in 2025 alone. This marked the 3rd year in a row exceeding 1,000 tons. Moreover, 68% of central banks surveyed in March 2026 indicated plans to increase gold holdings this year. Consider the magnitude. Gold has now surpassed U.S. Treasuries as the largest component of global reserves for the first time in 3 decades. Yes, for the first time in 30 years. Central banks collectively hold more gold than American government bonds. This is not merely a temporary trend. It signifies a profound structural shift within the international monetary system. BRICS nations, now including Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran, control 17.4% of global gold reserves, up from 11.2% in 2019. That is a gain of 6.2 percentage points in just 6 years. The acceleration of these holdings reveals the direction of future markets with stark clarity. Japan re-enters the story. Last week, the country spent $35 billion defending the yen. That same $35 billion did not flow into U.S. treasuries. Instead, it was drawn from Japan's foreign exchange reserves to wage a currency defense triggered by a Middle Eastern conflict indirectly initiated by America. The ripple effects of disruptions in the Strait of Hormuz are now directly eroding the foreign reserves of major U.S. allies. When these allies cannot maintain their own currencies without depleting reserves, they reduce treasury purchases. Fewer buyers of treasuries naturally weaken the dollar, creating a self-reinforcing feedback loop. Turning to silver specifically, this is where retail investors often remain underexposed. Currently priced at $76 per ounce, silver has dropped 18% since the Iran conflict erupted on February 28th. Its decline mirrors gold's energy inflation, higher interest rates, and the opportunity cost of holding non-yielding assets. Yet silver's industrial demand continues to grow, and in fact, it is accelerating. Tech giants such as Meta, Alphabet, Microsoft, and Amazon are committing $715 billion to artificial intelligence infrastructure, nearly doubling last year's $375 billion. Every hyperscale data center constructed relies on silver for electrical connections, chip packaging, and cooling systems. Every solar panel installed, now at record numbers, uses silver, with next-generation TOPCon and silicon heterojunction panels demanding significantly more silver per unit than older models. The combination of surging industrial consumption and central bank accumulation suggests the forces supporting silver and gold are intensifying. The current dip is temporary. The underlying trajectory points decisively upward. The World Silver Survey for 2026 forecasts a sixth consecutive annual shortage, projecting a deficit of 46.3 million ounces this year alone. Since 2021, a staggering 762 million ounces have been extracted from above-ground global inventories. That is metal that no longer exists. Wall Street has engineered a system in which 75 paper ounces of silver can be sold for every single physical ounce, stored in a deliverable vault. The COMEX coverage ratio, the portion of paper contracts that can actually be fulfilled with real silver, stood at 13.4% in late April, remaining below the 15% stress threshold for half a year. In January, 33 million ounces vanished from COMEX registered inventories in a single week. The disparity between the paper market's valuation of silver and the reality of physical supply is both documented and widening. This is crucial to understand. The Fed's paralysis, Japan's intervention, the dollar sitting at a 2-month low, central banks accumulating gold, and the persistent silver deficit, these elements are largely absent from the mainstream financial narrative consumed by most Americans. Headlines claim inflation is moderating, the economy is stable, and equities are safe. The Consumer Price Index was 3.3% in March, while core PCE continues above the Fed's 2% target. Oil remains above $100 per barrel. By any reasonable measure, this is far from a healthy economy. Institutional managers recognize this. They are quietly building gold positions, while central banks are steadily reallocating reserves from U.S. treasuries into physical gold. Japan spent $35 billion from its reserves attempting to prevent a yen collapse triggered by U.S. foreign policy decisions. Meanwhile, retail investors are guided to focus on the S&P 500 index. This is not financial advice. It is an analysis of how institutional capital is moving. Transparency is vital. The full picture deserves to be seen. Currently, the dollar's apparent strength is artificial, propped up by an oil shock that originates from ongoing conflict. When that shock subsides, if Iran's peace proposals via Pakistan materialize, and Brent crude slides from $110 toward $80 per barrel, the inflationary forces restraining the Fed and suppressing precious metals will dissipate. What remains is the structural story. A dollar gradually abandoned by 68% of central banks, a gold market where sovereign buyers acquired over 1,100 tons last year and are accelerating purchases, and a silver market facing 6 straight years of deficits, with a paper-to-physical ratio unprecedented in history. Last week's dollar weakness was not random, nor a fleeting anomaly. Japan, one of America's closest allies, had to expend $35 billion from its reserves because the economic consequences of the Iran conflict could no longer be absorbed quietly. When allies start showing strain visibly, the dollar's reserve status erodes incrementally, quantified in billions of dollars of interventions. Looking ahead, the upcoming COMEX delivery data from May will be critical. It represents the first major delivery cycle. since the coverage ratio entered a 6-month danger zone. This data will indicate whether the paper silver market is nearing a point where physical supply can no longer be suppressed. Market participants who understand this dynamic will be positioned well ahead of the crowd. The story is unfolding now. Observing these shifts in real time is crucial because waiting 3 months means reacting too late. The dollar, gold, and silver are all moving on structural currents that are stronger than short-term headlines. Awareness of these forces allows investors to see where the true pressure points in the global monetary system lie.